Mysterious at the opening, heavy and serious when describing failures, steady and confident in analysis, decisive when stressing lessons, and inspiring at the conclusion. Most beginners don't lose money because the market is random. They lose money because they trust signals that were never meant to help them. Indicators lighting up green, a clean breakout above resistance, a perfect moving average crossover. Everything looks aligned, everything feels logical, and for a brief moment it feels like certainty. And that's exactly the problem. Because in the market, the moment you feel most certain is often the moment you're walking into a trap. New traders believe they are reading the market. In reality, they are reacting to it. Always late, always following footprints that were deliberately left behind. This video is not about blaming beginners. It's about exposing a structural misunderstanding that almost every retail trader goes through. The belief that price action is honest. The belief that indicators reveal intention. The belief that confirmation equals safety. These beliefs are not harmless. They are expensive. Today, we're going to dissect the false signals that new traders trust the most, not from an emotional angle, but from a structural one. We'll look at why these signals appear reliable, why they fail so consistently, and what they actually represent from a smart money perspective. Because once you understand what these signals really are, you stop chasing entries and start understanding positioning. Every trader starts the same way. They open a chart, add indicators, and feel relieved. Relieved because now the market looks explainable, organized, predictable. Moving averages create structure. RSI tells you when something is overbought or oversold. Support and resistance give you clear decision points. For a beginner, this feels like learning the rules of a game. And in the early stages, it even works, just enough to create belief. A few winning trades, a breakout that runs, an indicator crossover that delivers profit. This early success is not accidental. It's how markets condition behavior. Because the market doesn't punish ignorance immediately. It rewards it just enough to build confidence. But here's the context most beginners never see. Retail trading education is built around visibility, not intention. Everything you're taught is based on what is easy to see. Lines, levels, signals, patterns. Almost nothing is taught about who benefits when those signals appear. Institutions don't trade indicators. They trade liquidity, positioning, and risk distribution. When a beginner sees a strong signal, what they're actually seeing is a moment where participation becomes predictable. Predictability is not an edge. Predictability is a target. And this is where the disconnect begins. The beginner thinks the signal is information. The professional sees it as exposure. The beginner thinks confirmation reduces risk. The professional knows confirmation concentrates risk. This gap in understanding is not about experience, it's about perspective. And until that perspective changes, the same false signals will keep producing the same results, regardless of how disciplined, intelligent, or motivated the trader is.
What actually destroys most beginners is not a lack of knowledge, but a misplaced sense of logic. New traders assume that if something makes sense, it should work. If price breaks above resistance, buyers must be in control. If indicators align, momentum must be strong. If multiple signals confirm each other, risk must be lower. This assumption feels rational. It is also deeply flawed. Because markets are not designed to reward correct interpretation. They are designed to exploit predictable behavior. The most trusted signals among beginners share one common trait. They appear after consensus has already formed. Breakouts occur when the majority agrees price should move higher. Indicator confirmations appear when momentum is already visible. Trend-following signals trigger precisely when participation is at its highest. And that is exactly why they fail. From a structural perspective, these signals do not represent opportunity, they represent exposure. When a large number of retail traders act on the same information at the same time, they create something far more valuable than price movement. They create liquidity. This is the pain most beginners never understand until it's too late. They enter trades where stops are obvious, positioning is crowded, and risk is asymmetrically stacked against them. They believe they are trading the market. In reality, they are providing the conditions the market needs to move against them. You can see this pattern repeat endlessly. A textbook breakout above a well-known level attracts aggressive buying. Stops are placed just below the breakout zone. Price pushes slightly higher, confirming belief. Then it reverses sharply, sweeping liquidity and invalidating the move. To the beginner, this feels like manipulation. To the professional, this is simply mechanics. Markets do not move because signals appear. Signals appear because markets are preparing to move. The mistake is assuming causation where there is only correlation. This is why beginners often say it worked in backtesting but fails live. Because backtesting rewards pattern recognition, not participation dynamics. It does not account for how behavior changes once real money, real emotion, and real crowding are involved. The pain is not just financial, it is psychological. Each failed signal erodes trust. Not just trust in the system, but trust in oneself. Confidence turns into hesitation. Hesitation turns into overanalysis. Overanalysis turns into paralysis, and eventually, the trader begins chasing certainty even harder, stacking more indicators, seeking more confirmation, believing the next signal will finally be the one that works consistently. That moment is dangerous, because the more confirmation a beginner seeks, the more predictable their behavior becomes. The revelation usually doesn't come from another indicator or strategy, it comes from a shift in perspective. At some point, every trader who survives long enough begins to notice something uncomfortable. The cleanest setups often fail. The most obvious trades often reverse. The moments that feel safest often produce the largest losses, and the trades that work tend to feel uncomfortable. This is not coincidence. What beginners interpret as strength is often distribution. What they interpret as confirmation is often positioning. What they interpret as momentum is often exhaustion. Once you see this, signals stop looking like instructions and start looking like evidence. Evidence of where traders are positioned. Evidence of where risk is clustered. Evidence of where liquidity is likely to be harvested. This is the shift from reading price to reading behavior. From a smart money perspective, false signals are not mistakes, they are tools. They exist to reveal participation, to draw in volume, to expose stops. Institutions are not fooled by indicators because indicators are built on price, and price is the end result of positioning, not the cause. When you understand this, the market stops feeling deceptive, it becomes mechanical. And once it becomes mechanical, you stop asking, is this signal correct? You start asking, who needs this signal to be believed? That question changes everything.
At the core of most false signals lies a misunderstanding about how markets actually move. Beginners believe price moves because information changes. Professionals know price moves because positioning becomes imbalanced. Indicators, patterns, and textbook signals do not cause movement. They reveal where participation is concentrated. This distinction is subtle, but it is everything. Take the most common false signal, the breakout. From a retail perspective, a breakout represents strength. Price pushes above a visible level, volume increases, indicators confirm momentum, and the narrative aligns. The market appears to be accepting higher prices. From a smart money perspective, that same moment represents something very different. It represents a sudden influx of predictable behavior. When price reaches a level that has been watched, discussed, and anticipated by thousands of traders, the response becomes obvious. Buy orders cluster above the level. Stop losses cluster just below it. Risk becomes one-directional.
That clustering is not a flaw in the system, it is the system. Large players do not need price to go up to profit. They need liquidity to enter and exit positions efficiently. Breakouts provide that liquidity. This is why so many breakouts briefly succeed before failing violently. The initial push is not confirmation, it is bait. Once enough traders commit, once enough stops are placed in obvious locations, the incentive shifts. Price no longer needs to move higher, it needs to move where the most liquidity resides. Now consider indicator-based confirmation. Indicators are derivatives of price. They lag by design. When multiple indicators align, what they are actually confirming is that a move has already occurred. By the time a beginner feels safe, risk has already increased. Smart money does not wait for confirmation. They position into uncertainty and distribute into certainty. This is why the strongest reversals often happen when indicators look perfect. Let's ground this in a concrete example. During the Bitcoin rally in late 2021, price approached the previous all-time high, around $69,000. Breakout anticipation dominated the market. Social media was flooded with projections, targets, and confirmation-based strategies. When price finally pushed above the level, volumes surged. Indicators flashed bullish across every time frame. Retail participation spiked dramatically. What followed was not continuation, it was exhaustion. On-chain data at the time showed large holders distributing into strength. Long positions became overcrowded. Funding rates surged, signaling aggressive retail leverage. The signal told beginners to buy. The structure told professionals to sell. Within days, price reversed sharply, initiating a broader decline that wiped out late buyers. This was not a failure of analysis, it was a failure of perspective. The signal did exactly what it was supposed to do. It attracted participation. Another common false signal is trend continuation. Beginners are taught to trade with the trend, assuming alignment equals safety. But trends are not linear processes. They are phases of accumulation, expansion, distribution, and reversal. When a trend becomes obvious, it is usually late stage. Participation is high, risk is compressed, and the margin for error is small. Professionals do not ask whether a trend exists, they ask where the trend is vulnerable. False signals tend to appear at those vulnerability points. They are not mistakes, they are invocations. This is why many experienced traders stop using the word signal altogether. Signals imply instruction. Markets provide information, not instructions. Once you view signals as information about behavior rather than direction, their role changes. A failed breakout is no longer frustrating, it is informative. An over-confirmed entry is no longer comforting, it is suspicious. The market is not misleading you, it is responding to participation. And the moment you understand that, your focus shifts away from predicting price and toward understanding positioning. This is where smart money thinking diverges completely from retail thinking. Retail asks, is this a good entry? Smart money asks, who is trapped if this moves? Retail looks for confirmation. Smart money looks for vulnerability. Retail trades outcomes. Smart money trades imbalance. False signals exist because they are effective. They consistently draw in the largest number of participants at the worst possible time. And until a trader understands this mechanism, no amount of discipline, indicator tweaking, or strategy hopping will produce consistency. Because the issue was never the signal, it was the assumption behind it.
What ultimately separates traders who survive from those who keep restarting is not intelligence, speed, or access to better tools. It is the ability to stop trusting signals as instructions and start treating them as warnings. Once you understand that most popular signals exist because they attract participation, your behavior changes naturally. You stop chasing certainty. You stop entering trades where the outcome feels obvious. You stop placing stops where everyone else places them. Instead of asking whether a signal is strong, you begin asking whether it is crowded. Instead of looking for confirmation, you look for imbalance.
You pay attention to where traders are likely positioned, where risk is compressed, and where pain would be most asymmetric. This doesn't require advanced mathematics or secret indicators. It requires restraint. You begin waiting for moments when price moves against expectation rather than with it, when confidence is high but follow-through is weak, when structure suggests vulnerability rather than strength. You reduce position size when signals look perfect, not when they look unclear. You become suspicious of trades that feel easy. You give more weight to context than to triggers. Over time, this approach reshapes how you interact with the market. Losses stop feeling random. Wins stop feeling lucky. Trades become decisions rather than reactions. And most importantly, you stop measuring success by how often you are right and start measuring it by how well you manage risk when you are wrong. That shift alone changes a trader's trajectory, because the market does not reward accuracy, it rewards survival. The false signals that trap beginners will continue to exist. They are built into the structure of modern markets. They are visible, repeatable, and seductive by design. The difference is whether you believe them. When you stop seeing signals as guidance and start seeing them as exposure, the market becomes quieter, less urgent, more mechanical. And in that quiet, you begin to develop something far more valuable than a strategy. You develop judgment. That judgment is what allows traders to stay consistent when others become emotional, to stay patient when others rush, to stay solvent when others are convinced. If this perspective resonates with you, then you're already further along than most traders ever get. And if you want to continue developing this way of thinking, not chasing signals but understanding structure, then this channel was built for that purpose. Subscribe to Staro Trading. Stay close to the ideas that don't promise certainty but offer clarity. Because in the end, mastering the markets is not about finding better signals, it's about mastering how you respond when everyone else believes they found one. Master yourself, master the markets.